exchange. The Shop and Exchange is going to be a virtual area that companies and individuals will be able to go in and purchase what we call affordable health care insurance. Most of your organizations will not be eligible to do that until 2016, as long as you have less than 100 employees. So I'm not going to spend time on that because I'll have to come back with another presentation talking strictly about the marketplaces and the exchanges. And that's an hour-long presentation all by itself. Okay? So, the Affordable Care Act is broken down into 3 specific shared responsibility areas. There is an individual shared responsibility. So 2014, everyone must have some sort of coverage, either employer offered insurance, Medicare, Medicaid, covered under their spouse, some other government-backed insurance, but they must have some sort of insurance, or there's going to be an individual penalty to you. So you will be responsible to talk to your employees about the workplace. That's another presentation that'll be coming when they give the date of how you'll have to do that. So just like you have, the Department of Labor has one of those required postings for workers' comp or things like that, health safety. They'll probably be added to that about where they'll get information about the exchanges. I'm not sure how that's going to look, but you will be required to be able to inform your employees about the workplace. You have questions? Was there a question? Yeah. Okay. So that's one portion. The other is the insurers share responsibility, and they are really carrying a load of that. So they're worried about their profits and their shares, in which they should, because they have to answer the shareholders. But the insurance industry is carrying the bulk of the financial transition, because of this particular Healthcare Act. And then the third is what we call the employer shared responsibility, which most of you and all of you fall under, because you have more than 50 employees, or what we call 50 full-time equivalent. So just kind of let me talk about that. When we're talking about full-time equivalent, we're talking about for the Affordable Care Act. We're not talking about full-time employees as the state recognizes it or as the Department of Labor recognizes it, but for Affordable Care Act to make a determination on whether you fall into the employer shared responsibility area. So, you know what a full-time employee is. However, you must also count up your part-time employees. So a full-time employee is considered someone that works 30 hours a week. And a full-time equivalent is, let's say if you have 2 part-time employees and they work 15 hours a week, add up to 30 hours a week, that's 1 full-time employee. So you must add up all of your full-time employee hours, and then you break that up by 30 to come up with 1 full-time equivalent.
I think that's a small business.
You think what?
That's about small business.
So, yes, it is. So here we are. We're talking about you, 50 and above. So an employer that is averaging 50 or more full-time, and this might not be in your slides, by the way, because Department of Human Health Services just sent this to me yesterday at 4 o'clock. So I will make sure that you get an electronic copy, but the information is the same. They've kind of formatted it a little different, but we're saying the same thing. So an employer averaging 50 or more full-time, or a combination of full-time and part-time, those employees are subject to these following rules. And an employer averaging less than 50 are not subject to these rules. All right. So if you have 50 full-time, 2 scenarios are going to possibly, affect you as an employer. First of all, either you do not offer coverage to at least 95% of your full-time employees. So just so we make sure we understand, the calculation is full-time and then part-time to add up to get to this threshold of 50 and above. But you are only required to offer healthcare insurance to 95% of those full-time employees. Okay, and I'll talk about why we're adding all these numbers up a little bit later. So, you either do not offer it, or the coverage that you are offering is not what we call affordable or does not meet minimal value. Those of you that raise your hand that are already providing healthcare insurance, you're already really meeting the minimal essential value, and it's already affordable. Okay? But let's just say, you do not offer, and it's not affordable, and one of your full-time employees goes into the marketplace or shop and purchases an individual policy on their own and receives a tax credit or subsidy from the government, you may be subject to some penalties. Or you might like the word fees better, but so it's a penalty. Okay, so I already talked a little bit about full-time employees, 30 hours a week, talked about full-time equivalent, gives an example of two employees equaling up to one full-time. There were some questions earlier about employers that are common owners. They own multiple businesses and stuff. Their numbers are aggregated together to come up with that 50 or above FTE, which would make them subject to these rules and requirements. All right, so the coverage plans that you provide, they have to have a minimum value. So the plan, on average, at least 6% of the total costs are incurred by benefits. You must cover. So someone came up to me in the other and talked about 60%, and I had not talked about the 60% yet. But this is where 60%, where the plans that you have, you need to be participating at least 60% of the total premium costs. There's a calculator that is going to be developed. It's not developed yet by the Department of Human Health Services that will be able to help you to go in and to punch in your information and let you know whether you meet this threshold or not. All right, that's about minimum value. Is it affordable? All right, when we talk about affordable, we're talking about the premiums that your employee pays as part of their share cannot exceed 9.5% of their annual income for a single plan. So, I'm employed by you, I make $100,000 a year, so my whatever I'm contributing cannot exceed $9,500 of my annual income per year for a single plan. Even though I have a family plan, whatever plan that you're offering, whatever that single plan was, it can't exceed 9.5%. Now think about this now. Right now, currently in our taxes, you have to, if you're going to do long form, you have to exceed 7.5% of your annual income to be able to claim medical expenses above and beyond that 7.5%. How many of you have been able to do that? I did it for the first time this past year because my wife had cancer, hip replacement, a lot of different surgeries, and I exceeded by $400. That is including my premiums that I paid for, which included my family premiums. It included my deductions, my co-pays, my prescriptions, my dental, my vision, transportation back and forth, and it's difficult to exceed that 7.5%. We're talking about 9.5% only for health benefit. We're not even including anything that they may be paying for dental or anything else or their other costs. That's a lot of money, okay? So understand when we're talking about affordable, you already are there. You are already there.
Question. It says household income, that would be the spouse, higher.
Oh yeah, sure, absolutely, absolutely. Can't exceed 9.5% for a single plan. The operational word here is for a single plan. That is that that measurement lever on whether it becomes affordable or not, okay?
So is the government requiring an employer then to find out what the spouse's income is?
No, no. See, that's gonna be a part of the individual responsibility. So you don't know what someone's spouse is making, and you shouldn't. You know, your concern is the premiums that you're paying, the premiums that they're paying, and then whether it exceeds 9.5%. Now, those of you that are offering healthcare insurance now, I mean, how many of you think that that's exceeding 9.5% of what your employee is contributing? You do?
No, I have a question though. Does that 9.5% include a deductible that your employee might have to contribute?
No. Well, right now, we're only talking about premiums. We're talking about premiums. So, you know, if the plan, you know, per employee, you know, is $10,000 and you're paying $6,000, that means they're only paying $4,000, you know, and depending on what your salary is, it would have to exceed 9.5% of that, okay? Of a single plan, by the way. So, bless you. How many of you have over 100 employees? How many of you have over 200? Okay. How many of you have over 250? Okay, good. So there's some little tidbits that I need to throw out here that are
There's
specific.
5 people raising their hand for over 250.
Yeah.
They're from the same group.
Well, that's,
There's not 5 employees for 250 people.
that's okay.
Okay,
Oh,
I
geez,
just wanted you to understand everything.
I thought you guys really had it going on here. I was ready to sell my house in Hilliard and move out here. And
Emily, you don't know.
I really was. So this is what's going on. And talk to your health benefits and to your payroll people, but on the W-2 form, you're not required unless you issue more than 250 W-2s. You are required to put on, obviously, in Botswana, what their wages were, but then also you must put in what your contribution was for that employee and how much they paid. Okay, so you know that lets the government know that you offer insurance and it's affordable. You know you're off the hook from that perspective. It wouldn't be a bad idea for any of you with over 50, you know, to do the same thing, to get with your payroll folk and you know whoever does the work for your W-2s, and to put that other information in there. They have the information available. But yet it already proves that you've offered, it was accepted by this individual, and it is affordable because there it is. It's how much they paid, it's how much you contributed, this is their wages. All right, so these are scenarios where you could possibly have to donate a fee. So your coverage is not offered to substantially all full-time employees. So a payment is going to be required, you know, if that one full-time employee goes into the market exchange, receives and purchases a plan out of there, and they receive a premium subsidy from the government. You may be subject to a penalty. The penalty that you may have to pay will be $2,000 a year per full-time employee. So we're not talking about the one employee that went out and purchased. We're talking about your total number of full-time employees minus the first 30. You may be subject to a penalty that is calculated out at $2,000 a year, approximately $167 per month, and that's based on your full-time employees minus the first 30. Now these are scenarios. So the insurance that you have, you're not offering it to at least 95% of your full-time employees. The other scenario is coverage is offered, but it's not affordable and does not meet the minimal value. Which all of you that already are doing it, you're already there. So then that payment is $3,000 per year per employee who receives a credit. All right, and that's based monthly, $250 a month. Is based on the number of full-time employees who receive a credit for that month, and that payment cannot exceed this scenario. All right? So I know that's kind of confusing. However, now I'm talking specifically to those that do not offer health care coverage at this time. These are the penalties that you may be subjected to, or you're exposing yourself to, okay? So, let's talk about that. So, we've come up with these numbers, you know, do you have 50 employees, do you have full-time equivalent, and does it exceed that 50 threshold? If it exceeds that 50 threshold, then you are required to offer insurance to your full-time employees. Everyone needs to understand, not your part-time, but your full-time employees. And you must offer at least 95% of your full-time employees. You do not have to offer insurance to part-time employees. If the coverage that you're offering is affordable, but yet the employee decides to decline what you offer them, you are exempt from any penalty if that individual goes to the marketplace and purchases. So basically, offering their insurance, they're either going to accept it or they're not going to accept it. You know, and there's going to be a block on there where they opt out. That is your documentation that you offered affordable health care insurance to that individual. You are not subject to any penalty. If that person goes to the exchanges and tries to purchase insurance and requests that they get a subsidy, it's going to trigger several things that's going to happen. The government is going to contact your organization. They're going to ask first, do you have health care insurance? Yes. Did you offer it to this individual? Yes. Is that insurance affordable? Yes. Fine, you're good to go. Now we're going back to the individual. You can purchase out of here, but you're not going to get any subsidies. And your employer is not going to be held responsible to share in that. So no payment is owed if they obtain that, you know, through the marketplace. Keep in mind, they can opt out because they're under their spouse's coverage or Medicaid or TRICARE. Again, you are not going to be subject to any penalty because they have other insurance and they have opted out. So the thing to really get here is to make sure that people are opting out if you're offering health care insurance. Would you agree, Donna? Agreed. Donna agrees, then I'm right. So beginning in 2015, those that offer full-time coverage, you know, will also have to offer coverage to children up to age 26. And this will be industry-wide. So children will be covered all the way up to age 26. My son is almost 14. I was really hoping that 4 more years, I didn't have to say his name much, except he's on his way over and he'll be leaving and such, but you know, but they'll be covered. Because generally, once they're that young and their insurance coverage from their parents expires, if something happens to them before they can get insurance, who carries the burden? Generally the parents. Even up to age 25, 20, could even be 30, but the parents end up carrying some of that burden of trying to assist them in whatever their medical situation is, or they're going in and they're getting insurance without paying, which increases health costs. All right, so there's a strong incentive, you know, obviously for you to offer insurance to your people. You know, I've heard some companies say, well, I calculated up, you know, my penalty will only be $68,000, but if I offer health care insurance, you know, then the premiums that I pay will be $98,000. Well, that's a business decision for you. But keep in mind, the $68,000 is now a sunk cost because it is not tax deductible. The $98,000 is tax deductible. So that's something you may want to consider if you're trying to figure out how to get out of offering health care insurance and just say, I'm just going to pay the penalty. And it will change depending on how many employees you have. Again, we're back over to Donna. Employers can offer coverage and have greater flexibility. Now, Those of you at 50 to 99 right now will not be able to purchase out the shop, but in 2016, you will be able to, all the way up to 100. Some states will allow employers with up to 100. Ohio has not decided yet, but Ohio has decided they're not going to participate in the state-run marketplace, so it doesn't matter. You are still eligible for the federal, those of you that end up in that criteria from 50 to 100 come 2016. Okay. All right, so just a quick summary of some of the other things that are happening in the industry. Insurance companies are required to give a summary of benefit and coverage rules. Right now, this month, by the end of the month, the insurance companies must make blind bids, on what their plans are going to be for insurances offered in the marketplace. But all insurances have to provide the summary and disclosure to the government, because the government is trying to protect your rights to make sure that in that print that nobody can read and nobody usually reads, but what's actually in there. The medical loss ratio rebates, remember when I talked about the 80% spent on premiums and the 20% on administrative? That's what we're talking about. If an insurance company does not spend 80% on your premiums or to increase the quality of your health coverage, then they are subject to have to pay rebates back to those that have paid them premiums. How the government is going to monitor that, calculate that, I have no idea. For those companies that issue more than 250 W-2s a year, you will be required to actually have the information on the W-2. Those of you that have 200 employees, you need to automatically enroll all your employees in health care